Welcome to the FEG Insight Bridge. This is Greg Dowling, Head of Research and CIO at FEG. This show spans global markets and institutional investments through conversations with some of the world's leading investment, economic, and philanthropic minds to provide insight on how institutional investors can survive and even thrive in the world of markets and finance.
I will be heading to Asia soon, and my first stop will be India. It is my first time back to India since COVID. To help me prepare, I've decided to call on my good friends at Malabar Investments. On this podcast, we will learn more about Malabar as a firm, but also hear about the Indian economy and stock market. What are the opportunities? What about the risks? And then finally, we will finish with some geopolitics. What does India look like after Modi? And is India a good alternative to China? Hear this and more on the FEG Insight Bridge. Gentlemen, welcome to the FEG Insight Bridge. Would you mind introducing yourselves and Malabar?
Sure. It's a pleasure to be here. I'm Sumit. My background is I grew up in central India, did my schooling there, came to Mumbai to IIT for undergrad. And after that, I went and worked in Europe and US for a few years. It was during that time that I got interested into investing. And I started learning about investing from mentors, from others. And as an engineer, I actually found this to be very interesting. It's like a problem that you need to analyze and understand. And that's what sort of got me gravitated to investing. And then came the realization that I don't know enough. That led me to business school. I went to Wharton, and that's where actually I overlapped. And that was really good because I ended up learning a lot about not just investing, but about management, about operations, about accounting, all the other nuts and bolts that you need to understand businesses better. And while I was doing that, I realized that some of my classmates who come from consulting backgrounds actually had really, really good ways of looking at industries and businesses. And I thought this is a great skill to learn. And I was lucky enough to get an opportunity to join McKinsey and Company and with them work on investment related work. And I thought I would do it for a couple of years, but it actually lasted a bit longer. But with them, I had a chance to work with some of the smartest investors in the world to evaluate investment ideas, both in developed markets, but also in India. And eventually that started to become more and more of my focus. And when I did that, I found that the best ideas were these small and mid-sized companies that were growing very well, but not many people were looking at them. And that sort of formed the genesis for Malabar. And so that's how we started Malabar back in 2007 and 2007 and 8. And so it's been 15 or 16 years that we have put those ideas into practice. And it's been a wonderful experience.
Hey guys, it's Akshay Mansukani. I grew up in Mumbai, used to be called Bombay. Went to Philadelphia for my schooling, the Wharton School, as Sumit mentioned, that's where I overlapped with him. I did my undergrad and my MBA, graduating in 2004, finished 5 years in Philadelphia and moved to UBS as part of equity capital markets as the investment bank in New York, doing derivatives, convertible bonds, buybacks. Was a wonderful learning experience in my kind of early days, 2004 to 2009. And my father, Vijay, founded a white goods business in India called Onida, ONIDA, and it makes televisions, air conditioners, washing machines. And he's a very trusting person and trusted a bunch of his life savings to homegrown private equity funds in the 5, 6, 7 vintage. And unfortunately, didn't go as well. And so we maintained a very good relationship and kind of said, look, Akshay, can you fix this investment problem I'm having? I kind of packed my bags, came down to India. I'd spent a decade abroad and did over 100 meetings with people in the financial space, large part of it public market investors. Met Sumit at 4 million in assets and really appreciated the heavy diligence. We were talking about long-term investing. At the moment today, we have 16 years of data to show it. Really appreciated the line in the sand on corporate governance, recognizing that we can generate returns while keeping a high level of integrity and ethics. And our conversations led to another. And I joined in 2009. I spent time both on investments as well as on the business development side. Been really proud of what we've been able to do with regards to the team, our investment processes, our LP base, our relationships with portfolio companies, and looking forward to chatting more.
Thanks for the introduction. We're thinking about calling this here the Bengal Growling. India is often referred to as the Bengal tiger, and also a little tongue-in-cheek because FEG, we're headquartered in Cincinnati, which is home of the Cincinnati Bengals. But being that you're both Philly guys, I wonder if we shouldn't maybe have called this Fly Eagle Fly or something like that.
I think it's a great point because as it happens, I think my two kids and Akshay's two kids both go to American school here, and the mascot for that school is Eagle. So I think that will go quite well.
Fly Eagle Fly. And actually, you were telling me before we recorded that the tigers are everywhere now in India.
Yes, the tiger numbers have increased. The number of sightings has gone up. And if any of you are traveling down to India, I would strongly recommend keeping a couple of days aside to go to a tiger reserve. There's some really nice hotels and spots with some good food, but it's quite a sight to see a tiger in the jungle.
That's great. All right, Sumi, where's the name Malabar come from?
So the name Malabar, if you look into the old maps, like from the maybe 1600s or 1700s, the entire west coast of India is called as the Malabar coast. And that was the coast where the European traders or investors first came to India. So this was sort of the gateway to India. And that's why we picked the name Malabar. But perhaps subconsciously, there was also the notion that one of my all-time favorite cuisine is Malabar curry. So maybe that had some impact on that.
That's great. So I'll be coming back to Mumbai for the first time post-COVID. So what will I notice different? And by the way, I hope I don't see a tiger in Mumbai. I'd like to see a lot of new development, but maybe not a tiger. But so what can I expect?
There's been a lot of change, I must say. And there's a coastal road that has come up on the ocean that has reduced my commute to work and has made traveling through the length of Bombay a lot more efficient. The metro work is ongoing, and we should have an up and running metro within a year and a half. Although our existing train network, as you know, is pretty important in terms of transporting Mumbaikars, as we call them. This infra spend is not isolated to Bombay. And I apologize, I call it Bombay because that's what I grew up with, but it's across the country. And I think that infrastructure spend is something that is so obvious when we travel and we see new airports, new roads. And these are the visible changes you will see. The other piece is electronic payment. Every corner of India now being forced to accept electronic payment through the pandemic is now allowing a UPI payment, which we'll go into more detail later if the chance permits. And that's been a visible change. I think in terms of what's not so visible, you see it in certain numbers and the like, but is the confidence that the Indian economy has to survive and sustain what has happened is the pandemic, and the entrepreneurial spirit has really flourished, recognizing that even if business was shut for a few weeks, we can come back strong. So I think there's been a change in attitude in the people as well, recognizing how difficult the pandemic was.
Well, I can't wait to see it. When I was there, a lot of this was starting. They were already starting digging the tunnels for the metro. And it's an interesting mix of old and new, but you saw a lot of the new buildings and everything going up. You just couldn't get there. The traffic was just horrendous. So that's great to hear that they're spending on infrastructure, not only in Mumbai, but around India, because it definitely needs it. For those that aren't as familiar with the Indian stock market, can you kind of give listeners a gauge of how big it is and what it encompasses?
So Indian market is about 5.2 trillion today in US dollars. Quite small compared to the US market, but sizable. But very importantly, it's actually growing rapidly. It's growing because of the underlying growth in businesses and leading to sort of higher market capitalization, but also a very thriving IPO market. So a number of new companies are getting listed, and that's sort of adding to overall market capitalization. And that's what's sort of creating opportunities for both domestic as well as foreign investors. And you see the impact of that in terms of indices as well, right? So if you look at the emerging market index, India used to be a fraction of where China was, just a few years ago. Perhaps China was about 40%, India was about 10%. If you look at the latest numbers, China is still the largest, but it's about 24%, and India has crossed 20%, right? So the difference has actually become a lot smaller. But the thing is that the mindset takes longer to change, right? So the investors still don't appreciate that fact that India has become so much bigger in the emerging market index, and it's something that really need to look at, to evaluate, to understand, and over time invest.
That's an interesting point about the IPOs, because the U.S. market has done tremendous, but a lot of private companies are staying private. And so you're not getting access to some of those newer companies. Our stock market is just generally kind of getting older. So it's interesting. The other thing too, always blows me away with the Indian stock market is how many companies are listed. There's a lot of companies listed on the Indian stock exchange. Sumit, offhand, do you know roughly what that number is? A lot of other emerging markets, China's different. China's similar, but a lot of other ones, there might be 400 stocks. I mean, you guys have thousands, right?
Yeah. I mean, if you look at just the two largest exchanges, the National Stock Exchange and Bombay Stock Exchange, between them, there are about 3,000 listed companies. Outside of that, there are also sort of smaller exchanges around the country, and there are sort of few other 1,000 companies that are listed in those. So it's a very large, thriving, broad market, which is very unusual for an emerging market. And the reason for it is that if you go back, 20, 30, 40 years ago, there was really no other source of capital. It was either family capital or the public markets. There were no VC firms. There were no private equity firms. And so many businesses, this as the only way to raise capital. And that's why you have this sort of broad range of companies that are listed. Obviously, they're not all high quality or investable, but you have a lot to choose from. And there is definitely a subset of that, which is very high quality. And that's the subset that we would look at.
Yeah, if you add all those different exchanges together, I believe there's more listed Indian companies than there are U.S. companies, because our number has definitely shrunk as companies have merged and gone private and everything else. So that is certainly one reason maybe to consider an investment. What are other reasons why should investors, foreign investors or U.S. investors, invest in India? Because boy, the U.S. stock market's done well for a really long time. What do you get when you invest in India?
So if you look over the last several years, India has been the fastest growing large economy in the world. And if you look at the underlying factors at play, it's likely that it will remain like that for at least the next decade or two. And so when you have that strong tailwind of an economy growing at 6 or 7% in real terms, probably 10 or 12% in the nominal terms, it just gives a lot of opportunities for companies to grow. And especially if many of these companies are in sectors that are quite nascent, that have a long catch-up to go, it just provides a very conducive environment to generate good returns. And I think that's something that has been quite unique about India, where the economic growth has translated into earnings growth for the companies, and that earnings growth is translated into market returns. Because I think that's one of the criticisms that you hear about some of the other emerging economies, where those two haven't gone hand in hand. But India has been an exception. And if you get into this competition, but if you were to compare India to the US, if you pick the last 10 years, which arguably have been very, very good for the US market, in the last 10 years, if you look at S&P earnings growth, has been about 7%. If you look at the BSE 500, which is equivalent of 500 companies, that have grown over 12%. If you look at the returns in dollar terms, S&P has given 11% compounded over the last 10 years. Indian markets have given 13% compounded. So India has been a really standout, when it comes to the other emerging economies, and even compared to the best performing developed market in the world. And so I think that's the reason why to look at investing in India. That here's a country that is quite large, and the market is sizable at the current juncture for people to invest reasonable amounts of capital and generate very good returns, from there. And what's driving that is that, India is the most populous nation in the world. It's got 1.5 billion for almost that, people, many of them sort of moving up from, lower income levels to medium to high income levels. And as their disposable income increases, they spend a lot more on discretionary items. And that's what creates opportunities for other businesses. If you look at the financialization in the economy, it's still at a very low level. As that increases, it creates sort of further opportunities. And at a qualitative level, I can tell you that, when I graduated and landed up in Europe and later in the US, I used to be amazed to see some of the innovations there, right? It's interesting to see that the same reaction from my friends who are visiting India from US or Europe. They come here and see that we have 24/7 banking transactions, right? You can do anytime and it gets done within seconds. All you need is somebody's phone number to be able to make a small payment to them. It's just amazing how seamless that is and how scalable that is. And those numbers of digital transactions, they're growing rapidly, right? They've gone 10 or 11x in the last 5 years. So it's an amazing growth, that digital public infrastructure that has been created. Other example I would give is the new business models that are coming up, like quick commerce. They don't exist in many other markets. They definitely don't exist in global markets. In India today, like if I were to, you can name me anything. I can order it on my app and it will arrive way before this podcast. And it could be anything from anything that not just what you want to eat, but it could even be, let's say, if this microphone isn't working, I can order a new microphone to be here within 10 minutes. These are the kind of innovations that are coming today. And when people come from outside, they say, wow, these are sort of some of the invisible or intangible things that are happening in India today. And that's creating opportunities for businesses to create value for themselves and for their shareholders. And to participate in that, the investors have to come here and invest in.
No, that's a great commercial. And a couple great points there. I love the point about China because China has experienced an amazing economic miracle. However, shareholders have not benefited from that economic miracle. There's been much more of a direct follow through in the Indian stock market. So I think that's a great point. So you make that point on the why India, but why do you need a specialist? Malabar are a Indian specialist. Why can't I just get my Indian exposure from some EM manager in New York or London or just buy an index?
When we think about the emerging markets, they are so different from each other. The level of growth, the risk profile, currency, there are numerous things at play. The EM index can be bought, but the kind of aggregate returns haven't been there for a host of reasons. Ultimately, kind of picking kind of what Sumit described as the reasons, to potentially invest in India, you're kind of making an informed decision on a single country, even if it's a small amount of the capital that comes through. The returns have been there, over a period of time. So I think an economy and a market that is actually proven to generate dollar returns is important. On the index fund side, they do exist, and the returns have been kind of more muted in line with where the larger company growth is. However, as we think through kind of the specialist, and we like to call ourselves a boutique, but specialist may sound better. Ultimately, we're finding those uncovered gems, right? If you look at the portfolio today, from the largest private milk business in the country, which has been in the portfolio for a decade, earlier on a pressure cooker business. In these names, we're the first institutional investor coming into these names. And these companies are the 800-pound gorilla in the space that they're playing in. And being able to ascertain integrity, their kind of long-term plans, their capital allocation, the jockey, we believe, is pretty important decision-making in addition to the investment thesis. And so being on the ground and finding the right people running some incredible businesses is what we do. The earnings that Sumit mentioned for the portfolio, we've done a 31% earnings CAGR as reported for the last 5 years for Malabar India Fund. And that's the power of being able to find some of these smaller companies that are in niches that are growing at a rapid pace. And us as an investment manager also being aligned with our investors. Sometimes that doesn't happen in an EM, or an index fund. And so we're the largest investors in our own funds. Almost 17% of capital is represented by the team and the GP. So I think there's a room in a space that is extremely inefficient. You have hundreds of companies going public in the last few years. Many of them are smaller. Their head offices in different cities. It's difficult to kind of access some of these companies. I mentioned the private dairy, the founder, the largest private dairy in the country. It's been public for a while. He refused to speak to investors. And I give Sumit a fair amount of credit for having built that relationship. And he was at our annual offsite a couple of years ago. He said, I don't believe talking to investors is a good use of my time. And I do only talk to 2 investors, and they don't do any earnings calls. And it's been one of the biggest value creation stories that have been out there in our kind of consumer space. It's been an incredible business where even the largest company in the country, Reliance, has tried to enter. Danone, the French dairy giant, has tried to enter and failed. So being able to go down to the grassroots and find these businesses, I think is, where we come in as a specialist. We're on our toes, recognizing that our space is continuing to create more IPOs. Some of them investable.
So those are all the positives. There's got to be some negatives here. And one of them that comes to mind is that, India is great, but isn't it always really expensive?
That's true. I mean, India, as far as I remember, has always traded at a premium to other emerging markets. That may be reason to sort of overlook it. But the reality is that India is probably the only country in the emerging market that has actually performed. And so if you unpack that, if you sort of slice and dice the reasons for why that high multiple it's because of the composition of the index, right? So if you look at the Indian index, it's probably much higher quality companies. If you look at their return on equity or return on capital, you look at their profit margins, if you look at their earnings growth, they have done far better over a longer period of time versus the other emerging market indices tend to have companies that are either resource heavy or they are state-owned enterprises and so forth, which generally should attract lower multiples. And so I think that's been, one of the reasons for differences. And I think if you were to find the top 30 or 50 high quality companies in other emerging markets, you'd probably get to a multiple which is very similar. So I think that's sort of one thing to keep in mind. But ultimately, if you look at the earnings growth over a long period, if you look at the market performance over a long period, I think India has continued to deliver, and that's what has sort of created that interest in India. Moreover, I think until about a decade ago, there was really no culture of putting one's savings in India in public markets. First of all, the level of savings that went into financial assets was a very small fraction because most people wanted to be in inflation hedging assets like real estate or gold. So only a small portion of saving went into financial assets, and even most of that tended to be sort of fixed income. And so a really small fraction, I think the numbers are like 3 or 4% that actually went into public market. And that has started to grow as inflation has structurally come down in India, as there has been, with the reforms that the Modi government has brought in, there's been a clampdown on sort of this black money or untaxed money. A lot of it used to go towards real estate and gold. And once people have sort of paid taxes and they call it the white money, there is no disadvantage to investing in public. So I think a lot of those performance has driven interest. Lack of other options also, created that interest. And so there is a substantial amount of inflow or interest that is in Indian public markets from domestic investors. And it comes through the systematic investment plan where every month on a specific date, a certain amount of money goes from people's bank account and invests into their choice of mutual fund. And once those things are set in place, there is an inertia not to change that. And so that monthly inflow has reached about 3 billion a month today. And that's what creates a flow. And so from the point of view of a foreign investors, it's almost like having a put option that exists. And so again, for all of these reasons, India has continued to remain of interest to foreign investors.
No, that's great. The point about domestic investment, that's very different than some emerging markets where there really isn't, all the investors are typically foreign. So you have this growing domestic demand. Yes, I've heard the argument many times that premium growth deserves a premium. Therefore, it should be a little bit expensive. The other point that I really love that I think is very true that you made was that if you compare it to different emerging market countries, and you could just throw it like Brazil or South Africa, you're right. You're absolutely right that from a sector perspective, they just have a lot more mining and natural resource, basic materials that just around the world, these types of companies trade at lower multiples. So you kind of have to make that apples to apples comparison. So that is helpful. Now, yes, you have a lot of stocks and maybe they're not as overvalued as they seem, but what about liquidity, especially since Malabar tends to invest down the cap spectrum? Is liquidity a risk in the Indian markets?
Yes, the liquidity is definitely a risk. And moreover, in the small and mid-cap space that we're playing in, we deal with it through a few ways. One is being upfront and communicative to our investor base with regards to what we're doing. Our average hold on our positions is 7 years. And ultimately, we're buying these companies to see the earnings grow. And if markets go through their cycles, and they do, at the wrong point in time, pulling out can be detrimental. Along the way, we realized that we really wanted that long-term capital. So today, 90% of our capital base is in our long-term share class, which after the initial locks is a 2-year rolling lock, which effectively allows to slowly exit the illiquid part of the portfolio over a few quarters without disrupting the portfolio. The initial years for us, we slowly grew our asset base because we were so clear in terms of this point. Now, what the screens do not show on the liquidity is the blocks that sometimes people call into us. And if the businesses are sound and of high quality and the management teams are communicating the story, we land up getting inbound requests for blocks in a host of different instances. Our largest position today is pharma business that makes APIs. And the Capital Group, for example, called us and wanted to buy our entire position a few months ago. And that's over $100 million position, relatively, smaller company. And so we did trim a little bit, but I think that's also important is if you are humble to appreciate kind of where your mistakes are and be able to catch them. On the flip side, if your earnings grow, there's a fair amount of interest for these names. And then also in terms of liquidity, where you really want to be is the provider of liquidity during corrections and being able to build a relationship with clients over a period of time. In certain cases, draw down only part capital, let them know that when there's a drawdown, we'll call in for some liquidity. And in certain cases, if there's a correction, that's what we've done. And so when the pandemic hit, we had existing commitments that we could draw down, and we raised some further capital in just a matter of months, allowing us to deploy close to $100 million of fresh capital in and around the pandemic, resulting in significantly better, IRRs for our clients. So if we're cautious, patient, communicative with our investors, and can take advantage of opportunity, the liquidity cycles can favor us.
You mentioned drawdowns. Feels like India always has some massive drawdown. It used to happen, I felt like it always happened like every summer. There'd be like this boom, like this, they'd go down. And do investors have to just kind of expect a little bit more volatility in India?
Yeah, I think so. I mean, we usually in the first sort of 10 minutes of conversation with a client, bring it up. This is like fasten your seatbelt. This is going to be a great ride, but it's going to be a bumpy ride. And that's the reality of the situation. We are in a volatile market, and the factors that drive that, whether it's, the flow in and out of foreign capital, risk on or off, even domestic market, there is a lot of sort of trading mentality, short-term, sort of horizon, and that leads to volatility. So I think those factors are there. They're very human. And so they will remain. It's just that the amplitude in India tends to be higher. For foreign investors, you have to know that the currency is actually perfectly correlated with those movements, particularly on the downside. And so it tends to exacerbate, that volatility of movement. So I think that volatility is there. But I think what is very important to know, this is price volatility, right? I'm not talking about the market overall, but if you look at Malabar's portfolio, in the 16 years, we have never had portfolio earnings decline. Even during the pandemic, which is probably one of the worst shocks that you can imagine, our portfolio is resilient enough to actually grow its earning by a little. And I think so that's a very key, that if you're focused on intrinsic value, you know that intrinsic value is compounding year after year after year. If there's price volatility, the price comes down, it is actually a great opportunity to deploy more capital. But this is something you have to tell beforehand. When you have that, it's too late to go to an investor and say, hey, markets are down, your investment is down, put in more capital. It's almost like the fire drill, right? The reason you do fire drills is you tell people what to expect when it happens, because if it happens, it's too late. People are not in the right frame of mind to listen to you. And so you got to sort of communicate this early and often, that this will happen at some point. And just like you do in fire drill, your reaction at that point in time, to the extent you have liquidity, you should deploy more capital. And for the clients who have done that, they have actually experienced really good IRRs for doing it.
I like that. Buckle up. Yeah, that's your first meeting with a client to say it's going to be a great ride, but buckle up. We had on a few of them, just sort of liquidity and the volatility. Are there other challenges or risks facing the Indian economy or stock market right now?
Yes. On a relative basis, there is risk, and even on an absolute basis. And I think sometimes the world we live in, parameters of an analysis of risk is different. Personally, when I think through the Indian economy, and just the one big risk that stands out is the job creation. India should add half of the incremental workforce in the world in the next 10 years. We just don't have the jobs within the country to kind of cope. There have been actions the government has taken with regards to promoting manufacturing, skilling. We ourselves are supportive of organizations, community service organizations that help guide young students in terms of vocational courses. And so there are a bunch of actions in place, but that definitely stands out as a risk. In terms of how the risk pans out, if it does, there's a tremendous amount of our population, over 40%, related to agriculture. And we saw this in the pandemic when the jobs were not there. Effectively, people went home to their kind of native place and the villages and kind of, went back to agriculture. And so it is more of an inefficiency kind of issue as it comes up, versus I see civil unrest as being a very low probability. The other risk that we deal with is resource risk, recognizing our import of energy. specifically oil from our neighboring countries. We have good relations across the world. However, it is a big risk. If oil prices fluctuating do impact our deficits, the move on solar has been pretty stark and significant, specifically on companies that have factories where they're able to put up solar panels, effectively going into the grid on excess and taking from the grid as need be. And so the dependency is coming down, but currently it is a higher level of risk. The cycles of our economy in the current market, we've seen a slight credit slowdown, this lower spending from in the affordable price category, which is impacting GDP numbers. However, since the economy opened up in 1991, we've grown at 11, 12% on a nominal basis. And except for the pandemic year 2021, the economy continues to grow along. So coming off a low base with an independent financial system, with a young kind of hungry population with a low per capita GDP, it feels as if we have many more years of growth. And on the market, we've discussed volatility, valuations we've discussed. The only kind of point I'll make is on correlations with world markets. They do go up. There's crashes, the world markets, the financial crisis, the pandemic. However, on the way up, the correlations do break down and kind of try and the markets move in line with some of the fundamentals. And as Sumit was mentioning, the earnings growth for the market has done 12%. Depending on how you slice it, it's been almost similar the last 3, 5, 7 years. So ultimately, that what witnessing is a doubling of our market on a fundamental basis every 5, 6 years. I would say the volatility is definitely something to highlight, although over a period of time, the market should grow as they reflect the fundamentals.
Growing things create their own sort of gravity, right? You've seen Apple, for example, who's maybe kind of tapped out or finding new challenges in China, saying, hey, India is going to be our next market and investing in India. So you're definitely seeing some of that. I did want to ask you about private markets, because I know that's something that Malabar also does. What do private markets look like in India these days?
There's been an evolution on the private market side coming out of the British Raj. India has been capital starved. We have a tremendous entrepreneurial spirit with strong family bonds and a low cost structure, effectively resulting in numerous private companies thriving. And as the economy has grown and foreign capital has come in, private markets have evolved in a few ways. I think so. One is being more institutional in nature, having received either capital from a VC fund or a growth equity fund. The first wave of exits happened in 2014. So literally just a decade ago. So it's a pretty young market.
I think a Flipkart is kind of the big one that was the big winner for everybody.
Yes, exactly. And so the private markets exiting into the public markets, institutional capital looking for an exit, entrepreneurs realizing what it takes to take a company public has resulted in kind of a flurry of activity. So private institutional capital has also become a little bit more sector focused, and we see kind of sector focused vehicles being a lot more successful. And overall, this IPO activity should continue, recognizing this entrepreneurial activity. So the private markets are buoyant and exiting into the public markets. As we think through us and our private activity, being a public market fund, one would ask, are you doing anything? The answer is yes. We've been in a situation where we've done a lot of work going into an IPO. The IPO is over 100 times oversubscribed, and we've been left with just a few shares, and it's not been a good return of time. I think for us, we've realized that if a small portion of our capital is allocated to certain exceptional businesses, we're buying them a year or two before IPO, and we're holding on to them for many years after, we can actually conduct diligence in a way in which we're getting information that won't be available on the public market side. And once we are aware of that information, nobody can take it away from us. Building relationships with companies, potentially allocating into a size that's meaningful for us, and then also gaining from the price that we're buying at, going into the listing price. So this is something that we have done, and we've had some 18 IPOs, and today companies looking to go public. In certain cases, we are seen as the preferred partner. And the last point I'll make is, or 2 points, the different type of companies that we're able to access going into the private space is something that we have actively done. So, for example, the largest mobile advertisement business in India, Affle, is a company that we took public. There was no public company at the time doing this, and we were pre-IPO investors and helped them go public. So there is a different type of company that's out there that we can access, which sometimes may not be available. And then also being able to handhold companies through the IPO process. The first company that went public after the pandemic was a specialty chemicals company where we were the pre-IPO investors, and we were happy to take the risk in a shut market because the pandemic had just hit in the middle of 2020 to take the company public. And it was wildly successful given how strong the numbers were and the appetite for the stock. So I think on both private markets as well as our activity on the private space, it is significant. However, we have 7% of the fund, which is private at the moment. Recognizing being a public market fund, we have to be careful on our asset liability mix. But it's been a wonderful space to explore and invest for us.
Thank you for that. Let's finish with a few geopolitics. So we are in the U.S. entering the return of Trump, and with that is probably the return of tariffs. And China's probably in the crosshairs. What does that mean for India?
We sort of realized this, India as well as the rest of the world, that through the pandemic, countries had probably unusually high, unhealthy level of reliance on China when it came to manufacturing. And the problems that came with that were sort of very obvious during the pandemic. And so since then, there's not been any country or any large company which hasn't been thinking about how do I de-risk myself. So they have anyway been looking at alternate options. And when you think about alternate options, India is very viable in many cases. And in some cases, India is the only option. And so I think if, let's say, the Trump administration has further tariffs in China, and as people look at alternate options, India will be one of the beneficiaries for sure, specifically in cases where there is a sizable domestic market, right? So there's a natural case to have something manufactured in India anyway for the domestic market. And by the way, once you set that up, your cost of production is actually quite competitive. That even on absolute level, I mean, even if you look at today, average labor costs in India is probably what, a third of what it's in China. It's an English-speaking country, so easy to sort of communicate and coordinate with. And India also tends to have sort of a non-confrontational sort of relationship across a wide spectrum of countries. So that sort of makes it easier to work. Obviously, there are hindrances. There are hindrances on infrastructure, which, as we mentioned at the beginning, that there's a lot of effort that is being put to bridge that gap. And there's a long way to go there, but it's moving in the right direction. I think definitely India will be one of the places that will benefit.
What does India look like post-Modi?
I think it's more of the same, right? Obviously Modi government has done some really good job when it comes to reforms, when it comes to being business friendly, and also sort of taking an independent foreign policy and sort of increasing the station of the country. But you also have to see that, since the economic liberalization in 1991, it's like, 34 years now, India has continued to grow on average at about 6%, plus minus 1 or 2% here, right? And in that period, we've had governments of every different political composition that you can think about. But that underlying growth has continued. And it's because you have 1.5 billion people who want a better life for themselves and for their children. And that's a great motivator for people to drive the economy forward. And as long as that keeps happening, I think there will be better opportunities for investors to allocate capital in India. And as I mentioned earlier, now India is at a side where it ought to be a part of consideration set. Having said that, I think, Modi as an individual had done some really remarkable things in terms of connecting with people within the country and outside. It's remarkable, he was able to build that personal rapport relationship with leaders across so many different countries, even across political spectrum in those countries. And those are not easy shoes to fill. So it will be a tough ask for whoever comes in. But if history is a guide, the direction of economy will continue to be on the same.
People forget that India is the world's largest democracy. And sometimes democracies can be a little rough around the edges, but they tend to work over time. And India is interesting. They still have relations with Russia, China, even though they might not agree on everything. India is a very independent, kind of in the right spot, almost neutral in a lot of ways, where other parts of the world feel like they're kind of lining up east-west, and India's sort of in the middle, which is probably a good thing for India. So for listeners out there who want to learn more about India, any good books or resources you can recommend?
It's a pretty voluminous book. I'm giving that caveat up front. But if somebody wants to understand the history of contemporary India, sort of post-independence, there's a book called as India After Gandhi which is written by a very renowned historian called as Ramchandra Gua. And unlike many historians, he also happens to be a very lucid writer and speaker. So it actually reads very good as a story, but it's still a pretty big book. But probably one of the best accounts of how India came together to be a republic, how it sort of created a country out of 550 plus princely state and became a democracy. It's really, really interesting, the early part of how that came together and the extraordinary people who were there at the helm to manage the transition. And so if somebody's interested in India, I would recommend reading that book.
That's great. Akshay?
The one book that stands out for me is a book called I Do What I Do by our previous Reserve Bank Governor, Raghuram Rajan. The independence of RBI and in America, the Fed is almost assumed by many. And it's not the case in many other countries. And if the politicians are able to control monetary policy, it could be a disaster. When Rajan took office in 2013, the rupee was in a free fall, and he effectively talks about the actions he took and his lectures. And winding back, he was actually credited to have called the financial crisis in 2005, a couple of years before it. And so he's highly respected. He's not so popular recently in terms of how outspoken he is on certain matters. However, independence of the financial system and the importance of that to our world of finance is something that we really open up when we see the workings of the Reserve Bank. For me, kind of a must read for any investors coming into India.
Those are great suggestions. And he was a great independent financial voice for India. All right. So if someone is coming to India and maybe coming to Mumbai and had a few nights where they could grab a good meal, I'm looking for some good restaurant recommendations. I'll ask each of you to give me your best recommendation of asking for a friend.
Actually, my buddy from high school and his wife run a restaurant called Mask, Masque. And Mask has been recently awarded top 50 kind of restaurants in the world. It's one of those kind of gourmet style experiences, which is lacking in India. And so for me, I'm just biased given how close to home the founders of that restaurant are. You asked for one, but the other one on the seafood side is Krishna. It's kind of the one that we went to ourselves many years ago. And it's a basic joint, but some of the best fresh seafood cooked in Indian spice.
I do recall that. That was amazing and spicy. So warning to anybody going there. All right. Sumit, anything?
Yeah, so those are two great restaurants. In fact, Mask happens to be one of my favorite restaurants as well. To add one more, I would say Bombay Canteen is a terrific restaurant, a great vibe, and it's in Midtown, so easy for anyone to get to. So I would recommend going there.
So you have everything you need, right? So we've talked about tigers. You can go see tigers. You can see this amazing economic miracle. We've given you some books and even gotten some restaurant recommendations. So this has been an amazing podcast. So thanks, both of you, for just sharing your insights on India.
It was a pleasure to talk to you, and we enjoyed it. And looking forward to continuing our conversation and to visit India.
Greg, we're really looking forward to having you and Brian come to Bombay. There's a lot more than the restaurants and the tigers as well. So if anybody is actually coming, we kind of have a 2-pager on all the options of optional activities. So happy to share that at the right time and really appreciate you taking the time to conduct this podcast.
If you are interested in more information on FEG, check out our website at www.feg.com. And don't forget to subscribe to our communications so you don't miss the next episode. Please keep in mind that this information is intended to be general education that needs to be framed within the unique risk and return objectives of each client. Therefore, nobody should consider these to be FEG recommendations. This podcast was prepared by FEG. Neither the information nor any opinion expressed in this podcast constitutes an offer or an invitation to make an offer to buy or sell any securities. The views and opinions expressed by guest speakers are solely their own and do not necessarily represent the views or opinions of their firm or of FEG.